Good morning. Hello again. This is our third video in a row where we're kind of talking about the money cycle, and we're talking about different strategies that can be done to affect this. Again, my name is Rich Lamore. I'm the senior partner at Boundless Financial Solutions, and we just want to educate people. So when we look at how this, we talked about how we got here. We talked about the overall money cycle and how things work throughout history. We talked about the Federal Reserve and how they're in control and they do it for the banks. Let's talk about first some of the other thing, in terms of this, what's going on. When you look at you hear inflation, and you hear that we have to raise the interest rates to beat inflation. Well, that can work, but it doesn't work unless the interest rates are raised above inflation. And then you look at which math formula are you using to come up with what the inflation rate is. I think we're using Common Core math right now because it doesn't make any sense. And they're saying our inflation's around 8%. But using real math, it's really close at 18%. But even if it was this type of figure, 8%, you'd have to have interest rates 9-10% to make a dent on inflation. Well, that's not going to happen, right? So just understand that in a way they're toying with us. They're raising it, they're lowering it. If you have a mortgage, if the mortgage interest rates are 7% and people need a mortgage, who makes the money? Banks. If later they decide that they're going to lower interest rates and it goes down to 4%, people are going to refinance. And then who makes the money when they refinance? Banks. So they're in control, right? So then we look at what are the three things that can be done about what's going on? How do you get rid of debt? Because that's what causes deflation, which is really part of the money cycle here that just brings us down, right? So how do you get rid of debt? Well, the first thing you do is you can raise taxes. We'd have to raise taxes 3.5 times just to stop the bleeding on every person. That's not going to happen, right? Incredible. That's not going to happen. Secondly, your second strategy is you'd have to cut spending. Just like in your household, you have to cut the budget. Well, you'd have to cut the federal budget by 41% just to stop the bleeding. Not even cut into the debt, just to stop adding more debt on. That's not going to happen. So what's their third option? Print money. Print money, which causes inflation, which is nothing more than a mask for the debt or the cause of deflation, right? So what are our strategies? Well, there's two strategies. You got to have what's called, first of all, an inflation hedge. And then you have to have, secondly, a deflation hedge. So the inflation hedge is, having some gold and silver. You don't have to have a lot, but having some. Probably no more than 10% of your overall portfolio, but to have some gold and silver. Is that meant to be a great investment? It's going to go up so much percent over the next. No, it's not meant as an investment. It's meant as an inflationary hedge. The best case scenario is you pass it down to your kids and grandkids, right? But in case things end up going to Germany way or whatever, end up heading that way, and looking at the money cycle, at some point it will go that way. Maybe not in our lifetime, but it will go that way. You're prepared, right? The second way is to go into a deflation hedge. And we call that our managed risk strategy. And basically, you take a lot of high quality, high rated corporate bonds, and you do a laddered bond strategy, right? And what happens, a bond is loaning your money to a company. Let's say Verizon wants to build so many towers, and they need some money. Well, they'll probably issue some bonds, and when we buy the bonds, we loan money to the company. Bonds are much more protected, if you will, than buying stock where you're part owner, where you rise and fall with the company. With bonds, you're a little bit more protected. And when we do a laddered portfolio of highly rated company bonds, these are collateralized by the company assets. And what you basically do is, the bonds pay interest until maturity, and the principal's paid off at maturity. So, and you ladder them like a 1 year, 2 year, 3 year, 4 year. I like doing a 10-year bond thing, kind of a rolling thing, right? So what you do is with these bonds, with this interest from the bonds, is you purchase options, right? You purchase call options. So let's say, and you can do it on a stock, and I like to do it on a stock, on a gold, and on the U.S. Treasuries. Let's say that triple play, and it's not always a 1/3, depends on what's going on, but that kind of a triple play. And in doing that, let's say the particular stock, for example, is worth $400, and I buy a call option today at $400, and 12 months from now, it's now worth $600. I'm going to exercise that call option for $400, and then sell it for $600 and make $200, right? But what if it's only worth $200? Well, I'm not going to exercise the call option. I'd lose money. I just let it go away. And I didn't lose that money. What did I lose? I lost the interest. It never touched the principal. So the bottom line here is, this is a strategy. When the market goes up, you make money. When the market goes down, you don't lose money. Right? That's pretty much the strategy on how it works. So putting those strategies together, and what if we could utilize the leverage of like an insurance company to do this for us, and it would cost you nothing? See, if I did this for you, you'd have to pay me to do this. But what if, using the leverage of an insurance company, it pays me, you pay me nothing, we do the same thing, right? That's called an annuity, a fixed indexed annuity. And they're measured in units, not in dollars. So they can attach themselves to whatever currency's in play if our currency went away. So again, this is the strategies, the two different strategies. Have a good day.